So a lot of misconceptions about how buybacks really work. So here's how the economists think about it, instead of, say, for example, what the politicians say. Number one, buybacks enrich the wealthy. Sorry, that's wrong. A buyback is an equal exchange of shares at a given value for cash inside the company. We can talk more about that later. Number two, buybacks are good for the economy. Well, that really depends. Cash from buybacks can be used for consumption, savings, or investment. Cash may or may not have a better investment idea. It could go to the next Apple or to a tech company that goes belly up. Number three, buybacks come at the expense of Capex and workers' salaries. That's true, but not precisely so. Companies could use the buybacks to invest more or pay workers, but worker pay is based on the labor market, the demand for the workers' services and their productivity. Investment based on expected returns and demand for what's being produced. Could be the corporate executives have incentives to do buybacks instead of capital investment or paying workers more, Kelly. But that's the fault of the board of governors, of corporate governance, and the shareholders, not the buybacks themselves.
Well, and actually, we're going to have next segment, we're going to talk about some changes in corporate governance that are coming too.
Sure.
But Jim, not all buybacks are created equal, and this is causing some of the confusion. If you look back at the biggest buybacks since '09, the ones that have outperformed the S&P include Apple, Home Depot, Microsoft. But then you have Citigroup, GE, AIG, ExxonMobil. And those are the worst of the bunch who have done these major programs.
Yeah, so look, as Steve was saying, there's no one-size-fits-all answer here, right? So I have to look at value creation. I'm going to start from the macro side. I'm a fixed income guy, so I'm going to look at the debt. And sometimes there are opportunities to issue debt and buy back your shares, and I think that creates value. I define value as increased productivity. And that's how you get long-term.
Not just increased share price.
Not just increased share price. Okay, so increased productivity. So essentially, there are times like during QE when you can issue debt at very cheap prices and buy back your equity and lower your overall cost of funding. That's a good thing.
And a wave of companies have done that over the last decade.
Absolutely, and that's why corporate leverage is so high. However, there are times where if you did that more today, you'd get penalized for that in the markets because leverage is very, very high at this point. So now we're at that point where, yes, we've had a lot of, we've played that trick at this point. We have debt that's very, very high, but maturities that are very long, and the cost of that interest is very, very low.
And so your explainer, when you hear this argument being made, would be to say, look to the investors. There was a period of many years when a company announced a buyback, its shares would go up. That started to turn over the past year or so. When they announced big buybacks, the shares would often be flat, sometimes even turn negative.
Correct. Because, and I think a lot of that goes back to leverage. And I'm going to measure leverage as debt to EBITDA. So essentially, the more leverage that you're putting on, unless you're creating value, unless you're investing that money, so I would argue that Capex is really what you want.
Right.
You get good Capex, you get good productivity. You get good productivity, you get higher sustainable levels of growth, you get better cash flows into the future. That's the daisy chain that we need to follow.
Sure.
Now, effectively, there are times, though, when it is good to have these buybacks, and then there are times where I think we are right now where it's probably marginally beneficial.
The point, Steve, being it's far more nuanced. No one's out there saying these things are all good. No one's saying they're all bad. Even Warren Buffett, if you ask him, he's written about this in his annual letter. He says, tell me the price, and I'll tell you whether it's good. If you look at Apple last year, they did 80% of its buyback in the first 3 quarters when the share price was far higher.
And what were the numbers on buybacks in 2007, just before they cratered?
They were high.
CEOs are historic, but let's just be clear about something. Buybacks do not raise prices of shares. They don't at all. And I want to just give you a very quick example, if we could, of that. Here's a company, we called it XYZ, it could have been Kelly Evans Corp, that has $5,000 of assets and 5 shares outstanding. Jim, tell me if this is wrong here. Everybody has a share worth $1,000. They went and bought back 1 share for $1,000. Look at the next screen. Everybody still has a share worth $1,000. The company's $1,000 less cash. There is no increase in share value.
The only way that it happens, and there's kind of formulas you can use for this, but it could increase the earnings per share.
Right.
And if you increase the earnings per share, each share
might get,
becomes
except for
more
what's happened to the risk of the company now that capital is down and widget making is up.
If they're borrowing to fund, that's one thing. If they're using cash, then that's
if you were a horse and buggy company in 1910, then you did that and you reduced cash and raised buggy making as a percentage, you badly increase risk to that company.
Right, but if you bet on your car,
get your money back.
If you use it to invest in the automobile, Jim, then you do okay.
So look, you got to create enterprise value into the future. Those cash flows have to be there, and if you create more productivity, they're going to be there. So if you're doing buybacks for the right reasons, which I think most of the time is to reinvest in your company and get better widgets at a better price more efficiently, then I think that it's okay.